A country just quietly reduced its holdings of U.S. government debt for the sixth month in a row, and almost nobody outside a trading floor is talking about what that means for your money. PAUs twos. I watched the meeting where that number came up with my own eyes, and I have not been able to stay quiet about it since. I spent 21 days in Singapore, Zurich, and New York, sitting in rooms with the people who move billions of dollars for a living, not commentators, not people who talk about markets on television, the people who actually decide every single morning where the world's money goes next.
And what I am about to show you has a direct consequence for every dollar you have sitting in your bank account right now. A consequence that most financial advisors have never warned their clients about, because most financial advisors have never sat in the rooms I sat in, asking the questions I asked face to face 3 cities in a row. Tone, lower, slower, stay with me through every single minute of this video, because at the halfway point, I am going to reveal the one number that changed my own personal positioning the week I got home. Not a guess, not a theory. A number I saw with my own eyes on a screen in a room where nobody expected an outsider to be watching. Do not skip ahead. What I show you first makes that halfway moment land the way it should. And if any part of this feels true to you, subscribe right now because I am going to keep tracking this story as it develops, and you will want to see where it goes next. Let me start with the moment that changed everything for me on this trip. I was sitting in a glass conference room on the 32nd floor of a building in Singapore, across the table from 4 people whose entire job is to decide where a sovereign wealth fund puts its money for the next 10 years, and I asked them a direct question. I said, "What worries you more, the size of the debt or something else?" Every single person in that room gave me the same answer without hesitation. It is not the size, it is who still wants to hold it. I asked the same question 3 days later in Zurich, in a much smaller room with 2 people who spend their careers pricing risk on government bonds from every major country on earth. Same question, same answer almost word for word. The size of the debt has never collapsed a currency by itself. What collapses a currency is when the world stops wanting to hold it. And then I asked it again in New York at a dinner with someone who has spent 3 decades trading currencies for a living. Same answer again, 3 cities, 3 different rooms. One answer every time. Tone, lower, slower. Now let me tell you why I even believe people like that anymore, because 38 years ago I did not. 38 years ago, I was 26 years old and I made the worst financial decision of my life. I had borrowed $4,000 from my father to make a leveraged bet on a market I was completely certain about. I was so sure I was right that I put almost everything I had into that one position. My wife and our first child depended on me, and within 6 weeks, that position was worth almost nothing. I had to call my father and tell him the money was gone. I remember standing in the kitchen holding the phone, and I remember exactly how quiet the room got after I said it. That failure taught me the most important lesson of my career. I learned that certainty is the most dangerous feeling in investing. The moment I felt completely sure about something, that was the moment I had stopped checking myself. And I have carried that lesson into every single conversation I have had since, including the ones on this trip, 3 cities in a row. Pause twos, and here is the revelation I promised you at the halfway point. In that room in Singapore, on a screen none of us were supposed to be looking at directly, I saw the actual current share of U.S. government debt held by foreign central banks. It has been sliding quietly year after year for over a decade, not a collapse, a slow, steady walk downward. At the same time, I saw the number for how much gold those same central banks have been buying. It is the fastest pace of central bank gold buying in roughly 50 years. 2 lines moving in opposite directions on the same screen. Foreign appetite for dollar debt sliding down. Central bank appetite for gold climbing up. That is the trade the most sophisticated money on earth is quietly making with its own reserves, even while public statements from many of those same governments continue to describe the dollar system as stable. I said publicly before this trip that I believed the dollar's role in the world was slowly shrinking rather than collapsing. What I saw in that room did not change that view. It confirmed it with hard numbers faster than I expected. Let me show you exactly what is happening with the numbers themselves, in terms anyone can understand. Right now, the US stock market, measured by how expensive it is compared to what companies actually earn, is trading at a level higher than almost any point in modern history, except for the peak of the dot-com bubble in the year 2000. One well-known investment bank has projected annual stock market returns over the next 10 years in the low single digits, after accounting for rising prices. Compare that to gold, which has moved up sharply over the past 2 years, driven largely by central banks buying it for their own reserves, not by ordinary investors chasing a trend. Before I tell you what to do about any of this, I want you to feel the weight of one number. If your savings account paid you 4% interest last year, and the price of the things you buy every day and the price of gold both rose faster than that, then in real terms, in terms of what your money can actually buy, you got poorer while the number in your account went up. That is the part nobody explains clearly, and that is the part nobody is talking about. This has happened before, not once, many times across 500 years of financial history in different countries under different governments with different currencies. The pattern rhymes even when the details change. In 1923, Germany's government printed so much money to pay its debts that the currency became almost worthless within months. The result was that ordinary people who kept their savings in cash lost almost everything, while people who owned real assets like land, gold, and productive businesses kept their wealth intact. And then over the following years, an entirely new currency had to be introduced just to restore basic trust in the system. The people who held cash lost. The people who held hard assets survived. In 1971, the United States broke the direct link between the dollar and gold, a system that had existed since a meeting in Bretton Woods, New Hampshire, near the end of the Second World War. The result was over a decade of rising prices and a weaker economy at the same time, a painful combination that back then was new enough that economists had to invent a word for it: prices going up while the economy gets weaker. The people who moved into hard assets during that decade protected their purchasing power. The people who stayed only in cash and bonds did not. And in 2008, the world learned a different lesson, that even the safest-seeming financial institutions can fail almost overnight when trust breaks down faster than anyone expected. The people who had already diversified away from a single point of failure came through it in far better shape than the people who had not. Every one of these moments felt, at the time, like it was happening slowly, quietly, almost boring right up until it wasn't. That is what worries me most about today. It does not feel dramatic right now. It feels normal. And that is exactly how every one of these shifts has felt, right before the moment people looked back and realized it had already happened. Now let me pivot from history back to today, because the present-day evidence is sitting right in front of us. Central banks around the world bought gold at the fastest pace in roughly 50 years over the past few years. Gold itself has risen sharply over a relatively short period, a move driven heavily by that same central bank buying, not by retail investors. At the same time, the share of U.S. government debt held by foreign central banks has been quietly declining year after year, even as the total amount of debt keeps growing. Meanwhile, the cost of everyday groceries and basic goods has climbed noticeably over the past several years, faster than many people's savings accounts have kept pace. This is the gap I keep coming back to. The gap between what the most sophisticated money in the world is quietly doing with its own reserves and what the general public is being told to feel comfortable about. Many of the same institutions that describe the dollar system as fundamentally stable in public statements are, with their own money, steadily increasing their gold reserves and steadily reducing their share of dollar-denominated debt. They are making different decisions with their own money than the comfort they project publicly. That gap is the part nobody is talking about. Tone, lower, slower. So let me now tell you exactly what I personally did with my own portfolio after this trip. Not as advice, But so you understand how someone who just spent 3 weeks in those rooms actually responded to what he saw. Action 1. I moved 15% of my portfolio into physical gold and gold-backed exchange-traded funds, using well-known, widely traded funds like GLD or IAU, the kind available in any standard brokerage account. These are not exotic instruments. These are the instruments that the people who understand the mechanism use to protect themselves. Action 2. I reduced my exposure to long-term government bonds, moving that portion down to under 10% of my total portfolio. Because long-term bonds are the asset class most directly exposed to a slow decline in a currency's purchasing power over time. Action 3. I increased my exposure to inflation-protected government bonds, sometimes called TIPS, moving roughly 10% of my portfolio into that category. Because unlike regular bonds, these are specifically built to adjust upward if prices rise faster than expected. Action 4. I diversified a portion of my stock holdings outside the United States, moving roughly 20% of my equity allocation into a broad international fund, something like VXUS, specifically to reduce how much of my future depends on any single country's currency and any single country's stock market staying strong. Action 5. I built a cash reserve equal to about 6 months of expenses, kept separate from my investments entirely, because no matter what happens with debt, currencies, or gold, having cash on hand for real life keeps you from being forced to sell your other assets at the worst possible moment. None of these 5 steps require anything exotic. No offshore accounts, no complicated derivatives, no products your bank would need special permission to sell you. Every one of them works through a completely standard brokerage account, the kind most people already have. Tone, lower, slower. I told you at the start of this video that I could not stay quiet about what I saw on that trip, and now you understand why. The window for making these kinds of adjustments calmly before conditions force a decision does not stay open forever. I am not telling you the sky is falling. I am telling you what the quietest, most careful money in the world is already doing with itself, while the public conversation stays comfortable. I just told you what I saw on a screen in Singapore, in Zurich, and in New York. Here is what that means for your money in one sentence. The world's largest reserve holders are quietly shifting away from debt and toward hard assets, and the gap between that quiet shift and the public conversation is the single most important thing in finance that nobody is talking about right now. If this video was useful to you, subscribe because I plan to keep tracking these numbers as they update, and I will be back with the next reading. And before you go, I want one specific thing from you. Not a comment about your feelings, a number. What percentage of your own portfolio is currently held in cash and dollar-denominated bonds combined? Write that one number below, just the number. I read every single comment personally, and I want to understand exactly how exposed this audience actually is, so the next video can speak directly to where you are starting from.